Hello everyone, welcome to BT 12503 Business Finance. This is topic 3, Understanding Financial Statements, part 2, Balance Sheet. So in this part, we are going to discuss about balance sheet and to use the balance sheet to describe a firm's investment in assets and the way it has financed them. So let's go through with the balance sheet. What is balance sheet? It is a snapshot of the firm's financial position on a specific date. And balance sheet is defined by the following equation. We have total assets equivalent to total liabilities plus with total shareholders' equities. Now, in balance sheet, we have three main items. The first one is total assets, which represents the resources owned by the firm. So total asset tells us what resources the company owns. And those resources could either be short-term resources or long-term resources. Meanwhile, another item in balance sheet is total liabilities, where it represents the total amount of money the firm owns to its creditors, or we call it the company's debt. So we have a total assets here, and total liabilities talks about the amount of money borrowed by the company to finance these total assets. The amount of money the company borrowed. So that is why it's a company's debt, is the amount of money the firm owes to its creditors. And these creditors could be the banks, could be financial services, or could be bondholders. Right. Meanwhile, total shareholders' equity refers to the difference in the value of the firm's total assets and the firm's total liability. Or in other words, the shareholders' equity is the amount of money raised or invested by the company owner. Right. So shareholders' equity, again, is a source of capital which was raised through equity, and this is the money that the investor invest to finance these assets. As I mentioned in the previous chapters, what are the sources of capital a corporation can get from? The first one, they can get it from debts, which is this one, the liabilities. So they can get the money from the issuance of debt or by borrowing the money from the creditors to finance the assets that they have. Secondly, the company can raise the fund by getting people to invest in the company, right? This is what referring to the shareholders' equity. So it's the money invested by the company owner to finance the assets. And the last is retained earnings. This is the money that the company has in balance from the previous profits that they get, right? The balance from the profit that they get from the previous semesters, they reinvest and put in the company's account, which is called the retained earnings. So in the stockholders' equity, retained earning also, okay, is part of the shareholders' equity in balance sheet. Also used to finance these total assets. So let's go with the first one. This is how a balance sheet looks like in a T form. On the left-hand side here, we have the asset category, which are categorized into fixed and current assets. So in assets, they have either in terms of current asset or fixed asset. Right. What is current asset? It is an asset that the firm expects to convert to cash in 12 months or less. A firm expects to convert this asset in 12 months or less. So meaning this is for short term. For example, of current asset include cash, account receivable, inventories, and other current assets. Remember this term, yeah? Current asset is the asset that the firm is expected to convert to cash in 12 months or less. So current asset referring to short-term assets. And this is also referring to liquidity, or in Malay we call it tahap kecairan. If the liquidity level is high or tahap kecairan dia tinggi, that means the company has sufficient current assets. We'll talk more about that afterwards in net working capital. What is cash? Okay. Cash is, we all know, cash money. And even every day in our life, we need to have cash, right? In order to pay for our expenses. Same goes with the firms. Every firm must have some cash on hand at all times because sometimes the expenditures can exceed what they receive. So there will be times whereby the company needs to pay more than what they receive during that particular period of time. For example, company needs to pay salary of their employee or to pay all the utility bills. So there's a lot of expenditures need to be paid every month, but some companies, they don't get the receipt or money received during that particular time. So that is why cash is very important. This can act as an emergency purpose as well. Okay, if something bad happen, they need to pay it urgently, then the company have sufficient cash. So cash is very important. Next type of current asset is account receivable, which is the amount owed to the firm by its customers who purchase on credit. This is where you sell your items to your customers, and your customers bought this item not cash in hand, but they bought the item on credit. Dia membeli secara hutang. And this customer is expected to pay the money back to you, let's say in 30 days of time. So it's a money soon to be received by your customer. Okay, that is account receivable. Jumlah hutang yang syarikat belum terima oleh customer mereka yang membeli barang secara hutang. That is account receivable. So account receivable also is considered as part of current assets. It's not cash because it's a money owned by other people, which is soon they expect to receive. Okay. Next type of current asset is inventory. Inventory refers to raw materials that the firm utilized to build their products, partially completed items or work in process, and finished goods held by the firm for eventual sale. So it's a raw material let's say, if you open a bakery, what are your raw materials? Could be flour, kan, tepung. Could be sugar, right? Could be chocolates. What else? Could be syrup, right? And many others. So these are your raw materials which you will order from your supplier, okay, and being placed in your warehouse, okay, or in your shop. And these raw materials, okay, soon are going to be produced, right, into or transformed into a finished goods, right? Like what? Like cakes, for example. You know, secret recipe punya cake, kan? Chocolate indulgence, strawberry chocolate cakes, kan? Could be pastry as well. Zaman sekarang very popular pastry, kan? We have so many types of pastry nowadays. From Cromboloni lah, croissant lah, kan? And many others, cakes, pastry, what else? Etc. Okay. So these are inventory, what we call inventory. So it's either in the form of raw materials or in the form of finished goods. Okay. And speaking of inventory, this inventory ni in the form of items tau. Flour, sugar contohnya, itu items, right? So you bought the items and you need to resell it back, isn't it? And convert it into cash. So these items, let's say the finished good items, the cakes, for example, this cake, okay, it has to go out. You need to get somebody to buy and so that it will be converted into cash. Okay, so inventory, you have a raw materials, which in the end you expect it to be converted into cash. So if you have a high inventory cycle, high or fast inventory cycle, that means you are able to quickly convert the inventory into cash. If the cycle is fast, okay, fast inventory cycle means you bought the raw materials today and today you use them and to produce your cakes. Tomorrow you sell your cakes to your customers. Your cakes are so popular, every day you have demand for your cake. So every day you get your materials in and out, in and out, in and out. So the raw materials, you convert it into cash very quickly. Okay, so that is a good indicator. That is a good short-term liquidity indicator. A bad ataupun a very slow inventory cycle means you are not able to convert your inventory into cash. Very slow. You bought the raw materials today and no demand for your cake because people don't like your cake. It's tasteless. All right. Maybe every month you only sell one cake saja. Okay. So your raw materials are being kept in your warehouse for a longer period of time and you are not able to convert this into cash until your raw materials becomes obsolete. Sampai you punya bahan mentah ni jadi expired. So bila expired rugilah. When it's expired, it obsolete, then it's a loss, right? So that is a very slow and bad inventory cycle. And of course, the faster the inventory cycle is, the better, because we want to make sure your company is able to convert your inventory into cash. So that is why inventory is part of current assets, because it can be converted into cash very quickly, right? That is inventory. The next one is other current assets, which are which they do not fall into this one of the names category mentioned earlier. Okay, they are not cash, they are not accounts receivable, and so forth. Okay, there could be other types of current assets out there. For example, prepaid expenses, one of the common example of an assets in this category of the current assets. So next, we have the fixed assets. Okay, so fixed asset are the assets that the firm does not expect to sell within 1 year. Okay, it means is this asset is not that easily can be converted into cash. Okay, meaning to say we are referring to the long-term assets sebenarnya, these fixed assets. Okay, it's not can be easily converted into cash. For example, your office building, for example, it's not that easy to sell buildings within a few days of time. It takes time. Okay, and this fixed asset is not something that the company needs to liquidate ataupun cairkan. It's not something that the company needs to convert it into cash. Buildings, there's no need for the company to convert it into cash, right? This also include plants and equipments, or land, for example, land. Oh, there's no specific reason for the company to sell their land, because the company needs the land for developing the business, right? So that is considered as fixed asset. Same goes with equipments. Equipments are not to be converted into cash because equipments needs to be used for the company's production activities. That is fixed asset. And when you have a fixed asset, something like equipment, for example, or plants, or vehicles, for example, okay, involve a series of depreciation, ataupun in Malay you call it susut nilai, right? Susut nilai. For example, if you purchase a vehicle ataupun van lah, company van, it costs you around, let's say, 150,000. Now, after 1 year, the value of this vehicle might drop to, let's say, 130,000. This is normal, absolutely normal when you have a fixed asset. Okay, asset that depreciates in value. Okay, asset yang mana dia nilai dia, susut nilai dia berlaku. Ada susut nilai dia. From 150,000 drops to 130,000. Okay, because this vehicle has been used to travel. So after you use the vehicle, of course, there are parts that needs to be replaced, right? It's no longer new and original, it has been used. So that is why it has a depreciation value. So the value of the vehicle drops from 150,000 to 30,000. So it's a 20,000 drops in value. That is what we call depreciation. Okay, it's the sum of all of the, so accumulated depreciation is the sum of all the depreciation expenses charged, okay, against the prior year's revenue for fixed asset that the firm still owns. So let's say this is the first year, and then second year, drop another 10,000. So in total, the company has a total accumulated depreciation value worth around 30,000. So it's negative value, depreciation. So the gross plant and equipment is the sum of original acquisition price of the plant and equipment for this one, 150,000. This is the original price. And then it depreciate in value, 30,000. So 150,000, okay, you minus 30,000. What's the value in balance? 120,000, right? So when the original price of the equipment or the vehicle is minus with the accumulated depreciation, therefore this 20,000 is what we call the net value of the vehicle, okay, which is the depreciated value of the firm's plant and equipment. So for our case, it's the depreciated value of the vehicle. Okay. Another example in regards to plant and equipment. Let's say you have an equipment, you have a machines. Also, no, you have a oven. Okay, oven, which you use to produce your cake. And this oven, initially you bought it at $100,000. This is what we call the gross value. And then over the years, the first year, okay, because you produce your cakes every day, right? So oven though, the function of the oven is no longer original, and slowly it depreciates in terms of the values and also the capability of the oven, you know, to so-called survive lah. So that's why it has a depreciation value. So let's say the first year value depreciates around 10,000. Second year depreciate another 10,000. Third year the value depreciate another 10,000. So total accumulated depreciation is 30,000. This one. Okay. So 100,000 minus 30,000. So 70,000 is the net value of this oven. Okay. So that is on asset. Next, let's talk about the right hand side of the balance sheet. Okay. So just now we have assets. Now on the right hand side here, we have the liabilities, which can be categorized into two, either current liability or long-term liability. And other than liabilities, we have another one called the stockholders equity. Right, so let's look at these items. The first one, current liability, it represents the amount that the firm owns to the creditors that must be repaid within the period of 12 months or less. For example, accounts payable, notes payable. Current liability is the amount that the company owe, okay, to its creditors, okay, that must be repaid within the 12 months period of time. Okay. Let's say if I borrow your money, 10,000 ringgit, that means I owe your money, right? You are my creditors, and this 10,000 ringgit needs to be paid within 1 month. That is example of current liability. We call it a short term. Current liability is a short term liability. Hutang jangka masa pendek. Siapa yang berhutang di sini? Syarikat yang berhutang. The company borrows money from its creditors. The company has amount of money owed. They owe to the creditors. Examples of current liabilities, accounts payable, notes payables, and so on. And then another type of liability is long-term liability. Very obvious, it's a long-term. Usually it's more than 1 year. Okay, it could be up to 30 years. and so on. It's a long-term liability, refers to debt with maturities longer than a year. Okay, this is usually referring to bank loans or bonds. Yeah. So next we have the stockholders' equity. This includes the following: par value of common stock plus paid-in capital plus retained earnings. So this talks about the total of money, total of money invested by the company owner, company's owner, or we call this the stockholders. Okay. Now let's go with current liabilities, the items in current liabilities. The first item in current liabilities is accounts payable. What is accounts payable? This is where the credit suppliers extended to the firm when it purchased items for its inventories, right? This is where the company bought the items from the supplier on credit. Kali ini company ini berhutang dengan supplier dia. For example, if you are my supplier, okay, my hardware supplier, right? This is the hardware. So my company bought it from you as a supplier, but on credit. Okay, so I bought it for a cost around $20,000, and this $20,000 needs to be repaid within 12 months time. That is accounts payable. Jumlah yang syarikat itu masih berhutang dengan supplier dia ketika membeli barang. Okay, that is accounts payable. Meanwhile, another type of current liability is accrued expenses. Similar like accounts payable, but they are not the same. Accrued expenses incurred mostly within the company's punya operations, okay, but not yet paid. Similar with accounts payable, but this is more on operation. For example, if you have your employees and then you need to pay their salary, okay, they might have done the work for you, but they are yet to be paid, okay, until the following month or following week or month. So the wages owed by the firm to the employee are recorded as accrued wages. Sometimes companies probably they have difficulty to pay the salary and wages because they are insufficient in terms of cash money. They don't have enough revenues to pay their employees. So there are areas that needs to be paid to the employees. That is categorized as accrued expenses. So it's more related within the operational side of the firm. And then you have another type of current liabilities called short-term notes. These short-term notes is a debt instrument. It's a debt instrument created by the corporation, whereby, created by borrowing from a bank or other lending sources that must be repaid in 12 months or less. This is where you have insufficient amount of money to pay your employee. So what your company will do, the company will borrow money in the form of short-term notes. They borrow money from the bank or other lending sources, financial services companies, for example. They borrow money in the form of short-term notes, for example, in the form of certificate of deposit. Mungkin certificate of deposit is one of the items, okay, or maybe in treasury bills. Okay, these are examples of short-term notes. It's a very short-term punya debts. Let's say company borrow $50,000 just to pay the company, the employees punya salary and wages, and this money needs to be paid within 12 months or less. That is example of short-term notes. Okay. And next we have another type of debt, which is the long-term debt. So it's very obvious. It's all firm debts that are due and payable more than 12 months in the future. Okay. For example, a 25-year mortgage loan where you borrow money from the bank. Okay. Maturity date in the next 25 years. This money is to be used to purchase your land or to purchase a building. Okay. Normally the value is much bigger, maybe 1 million or maybe 20 million in values. Okay. So it's a long-term debt, high in value to purchase sometimes fixed assets like land or buildings or equipments. These are example of long-term liability. Okay. So if you involve in a construction business, for example, and you need to buy a lorry or backhoe, for example, so it costs you like 2.5 million to purchase that vehicle or equipments. So have to borrow money either from the banks or you get the bondholders. Okay, you borrow from the bondholders to finance this purchase of these assets, long-term assets. Another item on the right-hand side of the balance sheet is the common stockholders' equity. Right. So again, this is the amount of money raised from issuing equities to the investors. All right. So the investors are so-called the stockholders they are the residual owners of a business. The real owner, the true owner, the common stockholders, they are the residual owner of the business. This is what we meant by the ownership. The ownership. If you own the company stock, if you are the common stockholders, you are a part of the owners of the firm. Okay. And as a stockholders, as a common stockholders, you receive your dividend. Okay, whatever income in terms of dividend, after the firm has paid all of its expenses. Okay, operational expenses. Okay. After the company has paid the creditors in the form of interest and so on, then after the company has paid the preferred shareholders, then the company will pay you as a common holders in the form of dividend. Okay. So in balance sheet, the stockholders' equity items, okay, includes the following. You have par value of common stock, plus you have a paid-in capital, and also you have retained earnings. So speaking of stockholders' equity, actually it can be separated into two. The first one is par value of common stock. The second one is paid-in capital. Okay. Again, let me repeat. Common stockholders' equity is the amount of money raised ataupun invested by the company's owner. Okay, we got all the stockholders, the common stockholders. And this can be categorized into two. Par value of common stock. What does it mean? Par value of common stock is the face value a firm puts on each share of stock prior to offering it for sale. The par value of the shares has no relationship to the market value. So let's say the company has 45 million outstanding shares. 45 million units of outstanding shares. Meaning to say, 45 million of shares ini has been owned by the stockholders. Right. Times with the par value. Par value means the face value or the real value of the stocks. Okay, before this stock is being offered for sale. So let's say the par value was around $1. Okay, so this par value is what we call the first value before the stock is being issued to the public, before the stock is being sold to the investors. The par, that is par value, and it has nothing to do with the market value. So if 45 million units of shares times with $1 of par value, so it's equivalent to 45 million dollars of par value of common stock. This is the value. This is the amount of money. This is what we are referring here. The amount of money invested. Kalau par value of common stock, the value is 45 million. Next is the paid-in capital. Paid-in capital is the additional amount of capital the firm raised when buyers purchase the stock for more than its par value. This is when the buyers or the investors purchase the company stock based on the market value but not the par value. Let's say, for example, okay, the company has 45 million units of outstanding shares, where these 45 million units of shares were being sold not at par value of 1, being sold at market value. Let's say the market value was around $5. So 45 million units of shares times 5 million, how much? Sorry, 45 million units of shares times with $5 equivalent to $225 million. This is the amount of money raised or invested by the company owners in terms of paid-in capital. So paid-in capital again is the capital raised from investors who bought the shares at the market value and not at par value. Okay. So this is where the capital raised from the market value in the stock exchange. Okay. When the stock is being sold at the market price fluctuates. Okay, it does not. It's no longer stands at $1 of par value. It fluctuates. Okay, $1 might increase to $2 to $3 depending on how popular the stock is. If the stock is very popular, then the value will further increase from $1 to $2, $3, $4, and $5. And if you were the investors who are yet to own these company shares and you are interested to purchase, okay, you will buy at market value. You no longer get at par value because dah terlepas. Okay, when you want to purchase the company stock after it has been sold for the first time, then you will purchase it at the market value. So this 225 million is the capital raised when investors bought the units of shares at the market price, not at the par value price. Okay. Another items in the common stockholders' equity is the retained earnings. As I mentioned earlier, the money reinvested in the firm from the previous profits that they get. So let's go through this example of balance sheet for this company called H.J. Boswell. for 2015 and 2016. You can see here on the left-hand side here is the asset column where you have several items listed as current assets. For example, here you have the cash, you have accounts receivable, you have inventory, and you have other current assets. And therefore, let's look at 2015. The total current assets for HJ Boswell was around 477 million. And then the company has this gross plant and equipment. What is this? This is the fixed assets. So the gross plant and equipment is 1669.50. This is gross. Gross means you have depreciation, and this depreciation means it's a drop in value of the equipments. Okay, so it has to be minus. Then after the gross plant and equipment, you minus with the accumulated depreciation, you then get a net plant and equipment worth around 1287. So with this net plant and equipment, you plus with the total current asset of 477. Therefore, you get a total asset worth around 1764. So this is a total asset for Boswell in 2015. And how does the company finance this total asset worth 1764? So those assets will finance through liabilities and stockholders' equities. The first one through several items of current liabilities. You have accounts payable here, right? Money that is yet to be paid by the company to the supplier. Okay, it's around 184.5 million. The company also has accrued expenses around 45 million and other short-term notes ataupun short-term debt probably from the banks or other creditors, 63 million. So total current liability is around 292.50. And then after that, you have a long-term debt. This company has a long-term debt worth around 720 million. So if you add total current liabilities with long-term debt, you get a total liability of 1012.50. And the company also finance the assets through the stockholders' equity or the money invested from the stockholders. You have the common stock par value worth around $45 million. This is where, for this company, the par value is $1 times with 45 million units of shareholders' equity. So $1 times 45 million units, this is where you get 45 million in values, $45 million of common stock par value. Other than that, HJ Boswell has also paid-in capital. Okay, as I mentioned earlier, paid-in capital is the money invested by stockholders at a market value, not at a par value. So worth around 324 million. And the company also has a retained earnings worth around 382.50. So in total, this you add with this, you add with the retained earnings, therefore you get a total of common stockholders equity around 751 million.50. So total liabilities plus with total stockholders equities, therefore you get the total liabilities and stockholders equities around 1764, which is the same with the total asset. And this is how the company finance its assets, okay, using liabilities and stockholders equity. When you do a balance sheet, your total asset must be exactly the same with your total liabilities and stockholders equities. It must be balanced. It must be balanced because it reflects how, because this side, liability and stockholder equity, reflects how the company finance its total asset worth around 1764. So that is why it has to be balanced. Okay. So if you compare with 2016, so you see here, the company total assets is around 1764. And this one was being financed by total liabilities and total stockholders equities. And liabilities, you have, the company has short term and long term, right? So let's say for this one here, total current liabilities for 2015 was around 292.50, right? So if you calculate 292.50, if you divide with the total liability and stockholder equity here, 1764, it is around 16.6%, which means out of this total of 1764 million of total assets, around 16.6% of these assets were financed using short-term liabilities. That is what it means. So 16.6% or equivalent to 292.5 million were being financed by short-term debts to purchase these total assets. Meanwhile, the total liabilities divide 1764, 1012.50 divide 1764. Oh, very interesting. Meanwhile, the total liabilities contributes around 57.4%, okay, in financing these total assets. Meaning to say, long-term debt contribute more than half, okay, as the source of the financing of these total assets. While stockholders' equity divide with 1764, ah, 43%. Well, 43% of the money invested by the stockholders firm were used to finance these total assets of the company. So in other words, this value of total asset 1764 were actually financed, okay, were actually being financed by 16.6% worth of total short-term debts. Majority of it were financed using long-term debt. Majority by long-term debt, while 43% of money were financed by stockholders' equity. So you can see here quite a balanced proportion of capitals raised by the firm, either in the form of liabilities or stockholders' equities. But you can see here, the largest or the biggest contributor is the long-term debt. If you combine these two, 16.6% plus 57.4 is 74%. 74% of these total assets were financed by liabilities. 74% daripada jumlah aset syarikat ni dibiayai oleh hutang. So hutang syarikat ni agak tinggi lah. You can see that, you can say the value of liability of this firm is quite high. It's more than half. Okay, it's equivalent to 74%. And you know, when the company has debts, a debt means a commitments. It's a liability. A commitments in which company have to pay back to their creditors. Wajib is a responsibility. If the company miss to pay, then the creditors can take legal action. So it has a serious consequence if the company fails to pay their creditors. So there's a risk involved there when the company has too much of debt. But of course, if you have debts, if the company have debts, there are pros and cons. Ada kebaikan, ada keburukan. Okay, one of the danger, if it is too high, the danger is that the company might not be able to pay back. So that is why the company have to make sure they have enough liquidity. They have enough liquidity to pay their debts. Now, where do we look at the liquidity? So the liquidity we look at here. Okay, liquidity here. Why here? Because liquidity referring to short term ability. Okay, so liquidity here we refer to current assets. If the current assets, sorry, this one, referring to the total current assets. If the company has much higher value of total current asset compared with the total current liabilities, that means the liquidity level of this firm is high. Tahap kecairan syarikat ini sangat tinggi. If you minus total current assets minus with total current liability. So for this case, 477 minus 292.50. Therefore, what did you get? 477 minus 292.50. You get 184.5 million. This is what we call net working capital. So this is, if you want to know whether the company is highly liquid or not, is very liquid or not, we refer to the net working capital. It's a difference between total current asset with total current liability. Here, the net working capital is high, is very good, is positive, which means this company is very liquid. They have a high liquidity level. A high liquidity level means the company is able and have sufficient amount of current assets to pay all of their current liabilities. The company has sufficient amount of money to pay all of their short-term commitments. That is what liquidity talks about. Okay, here, the liquidity of an asset refers to the speed with which it can be converted to cash without loss of value. Okay, how? By looking at the net working capital. So if the net working capital is significantly positive, therefore we can say that the company is in a good position to pay their debts on time and is consequently very liquid. And lenders, normally they would consider the net working capital as an important indicator to firm's ability to repay its loans. So if one day my corporation wants to borrow money with one of the commercial banks out there, and the commercial banks needs to know whether my company able to pay the debt or not. So how do we do it? they will look at my company's net working capital. If my company's net working capital is very good, very high, that indicates my ability to pay back the loan to the bank. And this will influence and give confidence to the lenders, right? If the net working capital is high. Okay. So going back to the example here just now, although this company has a very high amount of debt, but the liquidity value here is quite strong as well. So that means it should not be a problem, although the company has high debt value. Okay, it's not a problem because the company has a very strong, okay, amount of liquidity level, okay, which means this company is able to survive for short term, right? So when they are able to survive in short term, they should have no problems to survive in long term. And you can see here as well, the fixed assets. The fixed asset also is very high compared to the total liabilities here. So they in fact have much higher fixed asset compared to the long-term debt here. Right? So it's not a problem, okay, if the company has high value of debts, as long as they have, okay, a high value of current asset and fixed assets as well. So they have companies, if one day your company have a lot of debts, you need to make sure that you have a very strong liquidity level. A strong liquidity level means you need to make sure your company have a very strong short-term ability, very strong short-term values, very strong cash, very strong receivables, and very strong inventory values, so that you are able to survive in short-term period of time. And you have to make sure you have a very strong value in terms of fixed asset as well, right? So a high liability depends on the company's ability, and also depends on how much asset that they have. Okay. So that is all about part 2. So I hope you have a good idea about balance sheet and also income statement, the part 1 that we discussed earlier, and hope it helps you to understand on reading the financial statements and to start working on your company analysis assignment. So that's the end of part 2. I'll see you in the next video. Bye-bye.